This is actually one of my favorite sessions I like to go through and talk about, because I'm actually talking with other accountants, and I'm sure you love numbers as much as we all do. You may not, and taxes. You may not love transfer pricing as much as we do, but maybe by the end of it, you actually will have an appreciation for it and maybe like it just a little bit more. I teach transfer pricing at Melbourne Law School, and I can tell you by the end of teaching, I just finished on Wednesday, it was a semester-long class. By the end of it, actually, I think I had a few people who would like to actually go into transfer pricing. So that was a definite win, and does happen frequently as time goes on. What we wanted to go through today, so just to get started and just to introduce, so my name's Shannon Smith. I'm the founding director of Transfer Pricing Solutions. We've been operating now for 16 years. I cannot believe how quickly the time has flown. Last year was our 15th birthday. So 16 years, I'm ex-Big Four. I used to be a principal up for partner at one of the Big Four and had been there for many, many years. We actually, Transfer Pricing Solutions, we try and focus ourselves on providing practical, proactive and cost-effective transfer pricing advice. And I guess where our focus is really trying to provide that service to accounting firms, but also to the end users as well, at the end companies as well, to provide some transfer pricing services as well. Now, for some reason, we're really having, there we go, really having technical issues today, but anyway, we'll keep going with this. We're actually based we started in Australia, so in Melbourne. We opened up in Singapore about 7 years ago. We have the team in Singapore, and we opened in Malaysia, I think it would have been about 5 years ago in Malaysia. So we are across 3 different locations as well. So when we're looking at with transfer pricing, what we want to go through today, I'm going to stop sharing. I'm going to let me just change my PowerPoint onto. Sorry, folks, this is what we normally do at the beginning before it goes on live, but it seems to be having a delay. So just give me a quick second to get this resolved. Yes, okay. I think we are back on track now. It was just doing a bit of slow motion, so I don't know where the slow motion was coming, and that will frustrate me because, as most people who know me know, that I like to speak really fast, actually. So maybe it's going to intentionally slow me down a little bit. But I just noticed it was just being a bit slow and sticky, so I've just changed where I've got the slides there as well. So just to go through a bit more about the group structure of Transfer Pricing Solutions and a bit about our background. So talking about that we are in Australia, in Singapore and Malaysia as well, and our team's located there. We have won a number of awards in the transfer pricing space in relation to also in all the different countries as well. The one thing that we are really, really proud of is that we have been ranked as what they call a tier 2 transfer pricing practice against all of our, I guess you could say, the tier 2 accounting firms as a tier 2 transfer pricing practice, and we are located in the 3 locations. So we're quite proud of that for our Singapore and Malaysia offices as well. So industry leadership, we have a lot of advice that we're giving in tax authorities as well. And so we're quite proud of that from that perspective as well. So my background, as I touched earlier, I, ex-Big Four, had spent 11 years working at one of the Big Fours in Melbourne, Amsterdam, Prague, New York, and returned to Melbourne. I stayed there 2 years and then went out and started up my own practice. I started to see a lot of transfer pricing coming more at the smaller end of town than the bigger end of town. And at that stage, it was really only the Big Four accounting firms that were providing the transfer pricing service. We have half our work comes from accounting firms. We do more than half the second tier firms around Australia, all of their transfer pricing work for their clients as well. HC, Hong Tran, who's been with us now, and we do have a delay on these slides. I don't know what that is, but HC has over 10 years experience in transfer pricing. He's been with Transfer Pricing Solutions now, I think now about 6 years, I think it's been going. And HC's actually been really instrumental in helping in the Malaysian office. He gets the luxury of spending. He's based here in Australia, but he actually gets the luxury of being able to go on a 2-week holiday every month or so, which is great for him, off to Malaysia and catching up with people there. So looking at today, what we want to go through, transfer pricing legislation. So what are the transfer pricing documentation requirements? What are the 5 questions? The commercial and financial relations aspect, what does that mean in a practical term? And the simplified transfer pricing record keeping options. We'll then go into what are the arm's length methods. Now, just knowing the arm's length methods, when I teach this at the law school, this actually goes on for about half the course, half of the master's course. So we're going to reduce that down into the space of just literally 20 minutes for that part, aren't we, HC? So there's a lot to cover. And then also, what does it mean as a tax agent from an IDS and ATO Risk Reviews audits perspective? So what we want to get out of today is to really help as tax agents, you kind of are nearly the general practitioner if you kind of align it to a medical world, but what can you do in the transfer pricing space to ensure that you've got yourself covered and supported from that perspective? So what are the requirements for transfer pricing documentation? Transfer pricing documentation, it should be prepared before lodging the income tax return. So, you might not be the one preparing it, but ask your clients. If you have transfer pricing issues, ask your clients, have you got the transfer pricing documentation prepared? It should be in the possession of the taxpayers. Now, often you might be working with a foreign subsidiary and they say, oh, look, don't worry about transfer pricing. My parent company is doing it. It's actually under the law, they are required to have it in their possession here in Australia, not just available when asked. And that's really important because when you're lodging the tax return, the public officer is signing the tax return on the basis that they're signing it on the basis that the transfer pricing is right. How do they know it's right if they actually haven't seen a copy of the transfer pricing? It needs to be consistent with the OECD guidelines, and it needs to address and explain the way in which the legislation applies. And that's really important because we do have Section 815B legislation here in Australia. If it's prepared by the parent company, they're not always going to know that. And also address on how the reconstruction provision. So I'll go through that. Now, there is TR 2014-8 that it suggests 5 questions to be answered in order to address these legal requirements. So what are we talking about when we look at these 5 questions? I mean, it's just 5 simple questions, but there's a bit to come out of that as well. So question 1, we're looking at, well, what are the actual conditions that are relevant to the matter or the matters? So what we want to hear in this case, and if you look at a transfer pricing documentation, this is what we would have called was our company, industry and functional analysis. So what is actually going on? What's the company background? What's the industry we operate in? Because based on that may dictate where we expect the profit levels to be and who's doing what and where are they doing it and what's the value. So what are the actual conditions that are relevant to these transactions going on? Then we want to look at what are the comparable circumstances relevant to the arm's length conditions. Now, this is the bit, and again, when I teach this at the law school, this is the bit that I do 2 whole sessions on what is comparability. And it's really important because what we're trying to do with transfer pricing, we're trying to say we have a cross-border transaction going on and we want to price it as though it was arm's length. When I'm selling a product to you as a related party, I want to price it the same as if I was selling it to a third party and then that third party sold that product. So what are some of the comparability factors? What are some of the factors that make the transaction comparable that when I'm trying to, in a sense, what we call benchmark it or try and make it so I've got this arm's length pricing aspect? What are those factors? What are some of the key factors? Is it related to payment terms? Is it related to, is the product comparable? Is the service comparable? What are the other contract terms in relation to that? So that we're looking at what are the comparable circumstances relevant to identifying the arm's length conditions. And you get this when you're going through that, I guess the first one, the actual conditions. You're trying to work out what's going on and how can I compare. Now, if I use an example and look at a simplistic example, I'm trying to compare apples with apples. Does it matter that the apples are red or green? Maybe it doesn't matter that the apples are red or green, and I can just compare the apples, my apples, with the other apples. But if the apples are red or green, would that change the pricing? And therefore, if it would change the pricing, what would that do to the pricing? Is that a comparable circumstance that would change the pricing? So what are the particulars of the methods used in the arm's length conditions? What we're looking at, this is the part where we look at, as transfer pricing advisors, what are some of the different transfer pricing methods? Now, it may be that your client uses a particular management transfer pricing way in which to account for the transaction. However, for transfer pricing purposes, tax transfer pricing, as I often like to call it, may come in and test it in a different way. And the reason might be the client's IT systems don't enable them to price the transaction in the way we would like to from an arm's length tax transfer pricing perspective. So this is the transfer pricing methods part of it, a part of the question. Now, I know some of this, when I'm speaking now, probably sounds like it's, you probably haven't heard a lot of these areas. We're going to bring that back as to what can you do as tax agents following just giving you these parameters on these questions. So what are the arm's length conditions, and is or was the transfer pricing treatment appropriate? So this is the question from the tax office. The answer to this one, this is the economic analysis piece. This is the bit that actually, if you ask myself or HC, we would say this is the most exciting bit. And if I'm going to have a challenge from a tax authority, this is where I want to have it, because this is where it's, you know, the technical and I guess kind of the magic happens in it. But this is us going out and trying to find arm's length pricing in our databases, benchmarking. This is the very, I guess, the technical part of it. But we're saying, well, what would a third party do? And then the fifth question that the ATO is asking is, have any material changes or updates been identified and documented? So what they're looking at there is, how are you keeping on top of your transfer pricing? How is your client keeping on top of it? So as you can see, when you look at these 5 questions, and you think, okay, well, they're the 5 questions I need to answer for transfer pricing. This basically forms, I guess, the underlying of what becomes then the transfer pricing documentation. Now, if this is something that you say, I'm not really sure I understand much of this, don't worry, we will talk about after on the implications for tax agents and what can you do and help with your clients. We do run a course, which is an all-day course, but I'm looking at maybe breaking it up into a few, 1.5 kind of webinars, maybe one a week for a few weeks, where I actually go in a lot more detail on each of these and literally run a webinar on each of those different topics. If it's something that maybe transfer pricing is going to excite you, then that we will be running that course again soon as well. So the other aspect that the tax authorities are looking at, not just Australia, we have our ATO Reconstruction Powers, but other tax authorities have similar, but maybe different name situations as well, is the commercial and financial relations as to why is the transaction that you've got going on cross-border and how it's priced, how are the commercial and financial relations? How is it commercially viable? What is actually being undertaken? And, from an arm's length perspective, would independent parties undertake that transaction? Or if they didn't undertake that transaction, would they do something different? So the issue with the reconstruction powers, and the reason you need to be aware of it, is the ATO has the ability to say, we don't care that you didn't actually have a transaction between the two parties and that you said for transfer pricing you don't have a transaction. We're going to actually reconstruct because we think you have a transaction. We think that you undertook different functions. We think there was a transaction, and the fact that you didn't charge one through your books, we don't care. We're going to adjust and we're going to make it a transaction. Now, that's the powers that the ATO has. So if you're going through transfer pricing documentation, you're going to want to make sure you consider what are those potential questions that you're going to be getting. So the reconstruction powers. Now, this is the reason why I'm highlighting the questions in the ruling and also the reconstruction is, as a tax agent, you're going to be working most likely on a foreign subsidiary here in Australia. and you're going to be told by their parent company, hey, don't worry about transfer pricing, we have got it sorted. We've had our professional service provider over in the US, UK, wherever it is, prepare the TP documentation, and we are A-OK, so don't you worry about it. What you need to do is to make sure that you highlight to them, and we can assist you with some wording on that, have they considered the Australian transfer pricing legislation? And I'm going to tell you that most likely, no, they haven't. And then when they go into an ATO review, it ain't that great. Let me just tell you, we're scrambling in our 28 days trying to get these things done. But the reconstruction is one that a lot of them don't consider because they don't know our ATO rules, and this is something that the ATO is going to ask for and jump into. So what are the reconstruction powers? They can recharacterize if they think the form of the transaction is inconsistent with the substance. You've got substance over form here, where independent parties would have entered into other commercial or financial relations. They wouldn't have done that, or where they just would not have entered into the transaction altogether. So those are kind of the key two legislative aspects that you have the OECD guidelines, but if you receive documentation from a foreign parent that's been prepared by the foreign parent or their advisor, or been prepared overseas, you need to have a flick through and just have a flick through it and see, is there a section on it that talks about the reconstruction provisions? And is there a section that addresses 815B? Those are the two things that you need to look at. And as a tax agent, you need to, in your management letter that you'd probably do each year, or here's your tax return and these are adjustments. Hey, on your transfer pricing, we note that you've had someone prepare this documentation. However, it does not appear to address 815B, and it doesn't appear to address the reconstruction powers. Okay, so that would be really important for you to be, instead of just to go, okay, I'll just accept someone else has done the transfer pricing, because your subsidiary company here may not know that that's the case, and you're the tax agent. So that's what I would definitely make sure, or even put the onus back on them. Have you had this transfer pricing documentation reviewed by an Australian an advisor, so that you know that it complies with 815B Australian legislation, and see what they come back with. So at least that way you've got it on that side. Now, one thing that I do see a lot in the SME space is also around the simplified transfer pricing record keeping rules. Now, these were issued, practice statement was issued back in 2014, and it's actually meant to reduce the burden of a lot of companies in relation to their transfer pricing. Now, one thing that we look at, and a lot of people do think it's only just related to SMEs, it's actually not. You can have a lot of large companies that are able to, or not large, but larger companies that are able to apply some of these kind of, I guess, the options available, especially around their services. So one of the things that when we're looking at this is eligible companies are required to complete and they must have documentation outlining the way in which they comply with the eligibility criteria. Now, this is really, really important. And the reason I say that is I've seen way too many times that people say, oh, we're just applying the simplified. They haven't gone through the eligibility criteria to make sure they tick all those boxes. Now, some of that criteria is they haven't derived sustained losses for 3 years. They don't have related party dealings with entities in specific countries, specified countries. That one gets a lot of them out. That happens, and catches them by surprise, because a lot of people haven't considered that, and they haven't gone through a restructure in the past year. So you are, even if you apply the simplified record keeping options, you are required to put something together to show that you comply with those. So I would get the criteria, get that, and then go through it and make sure whether your client does apply, does satisfy that criteria to be able to do it. But what it is the options available, small taxpayers, distributors, some low value added intragroup services, and then technical services. The two that I do really love, actually, I have to say it is really beneficial for clients, are the low level loans, because when it comes to transfer pricing, Debt pricing, so us working out what would be the interest rate. You can't just ring up your bank and say, hey, what would be the interest rate? Can I use that margin? Unfortunately, transfer pricing doesn't accept that. But for us to undertake debt pricing, it is very expensive. We need to work out the credit rating of a company. So think of your credit ratings that you often see, your Moody's and things like that. We need to work that out for your company who doesn't have a Moody's credit rating. And then once we have that, we then need to actually price the debt. And there's a lot of different factors. So that's quite an expensive exercise. So I always say to clients, where possible, if you can satisfy all of the criteria in the low-level loans, usually for outbound, we have more ability to be able to do that because you have to have it in Australian dollars. Inbound, often the loans are in the foreign currency. So we're not going to be able to do that. So it does save your clients a lot in being able to do that if they can. Otherwise, what the record keeping options are really doing is saving your client if they want to use those particular margins, so like distributor, 3%, if they want to use that, and they're happy with that, they don't have to go off and do a benchmarking exercise, which, is going to save them quite a bit of money. So it's really worth, with the simplified, just to make sure, if you've got any questions, let us know. But on the low-level loans, that's a real winner for a lot of small business, smaller end-of-town clients to be able to apply those. But inbound, unfortunately, we don't see a lot of them being able to do that. So now we're going to go through, we're going to make you semi-transfer pricing experts, aren't we, HC? HC is going to go through what are the transfer pricing methods. Now, I know you won't love it as much as we do, but the key on understanding these is so that you can really, when you're talking with your clients on it, you can start to relate what do we mean when we have management transfer pricing and arm's length transfer pricing. So I'll pass it over to you, HC.
Thank you, Shannon. Thanks for the introduction and also going through the 5 questions as well as the commercial rationality that's involved in transfer pricing. So once we have gone through the commercial rationality, then the next step is to test the arm's length nature of the transaction. And we have the international standards that's based on the OECD guidelines that Australia follows as well. If you go to the next slide, where first it's separated into 2 broader categories. First up would be your traditional methods, where historically there would be a preference in terms of using or selecting the arm's length method, so to speak, and that would be the traditional methods. But now that has the hierarchy phase has gone, you only need to choose what's the most appropriate method to test the arm's length nature of the transaction. Now, let's go through the traditional method first, where we have the comparable and controlled price method, the so-called CUP, right? So briefly speaking, under this method, you're basically comparing the prices between a controlled transaction against an independent transaction. Right. Going back to what Shannon has mentioned earlier, we're looking at in her example on the comparing apples to apples, right? Whether you have red and green apples, then it really depends on whether the impact on the changes in colors would then impact the pricing of it or not. So we have to go through the comparability factors to make sure that those 2 are actually comparable. So basically, the rule of thumb in CUP is that you're actually comparing prices between the 2. Now let's look at the other 2, which is resale price method and cost plus. The way of using the PLI of resale price of profit level indicator, which is the resale price and cost plus, we're looking at a gross level. Right, so resale price, we're looking at resale minus, where it's most suitable for distributors, marketeers. They're more or less reselling what they're buying, right? And on a cost plus basis, it's more suitable for manufacturers and service providers. Now, both these 3, we can use it for internal and externally, meaning to say that if you have internal data using independent data, then you can actually use internal internal methods to actually test these methods. And then on externally, if there are availability of the data, then you are able to use the external part. But then the constraint of looking at resale price and cost plus, if you actually use external methods, is that there will be constraints of the recognition of the cost of goods sold within each company across Australia, for example, where the recognition of the cost of goods sold versus the operating expenses may differ. Hence, there may be a limitation of using the resale price and cost plus. But for now, the rule of thumb is going through the gross margin and for both resale price and cost plus. Now, after the traditional methods, then we have a transactional profit method, which are the profit split and the TNMM, which is what we normally use, the transactional net margin method. Now, the key difference in the traditional method and transactional profit methods is that the TNMM actually look into the net level as opposed to the gross level, right? They're looking at after the operating expenses, looking at the operating margin or your net cost plus, depending on the characterization on your taxpayers to see whether you're a distributor, you'll be using the relevant profit level indicator on operating margin and net cost plus for manufacturers or service providers. Now, on a net level, based on experience, and also if you look at what the ATO would have preferred, would be tax authorities would be looking at the net level, because then that is where the profit level lies. And if you're using a gross profit, then the tax authorities may still use a TNMM to look at the net level where you're loss making, and to look at what has impacted on your operating expenses to make it making the loss-making position at that point in time. So, and then you have the profit split, which is another transactional profit method, where the only time that you're using a profit split is when there are contributions from one or more than one entity contributing to a creation of a valued IP, hence leading to a use of profit split. The split part would be, it's broadly categorized into a residual profit split and contribution analysis. Now, I guess that we can't really go in detail on these two, but the rule of thumb is that it's for entities that are contributing to a value creation of an IP, for example. So once you have that scenario, then a profit split would be the most appropriate to actually identify what's the split between the two entities. And then lastly, you have other methods. So what the guidelines, OECD guidelines mention is that, apart from these 5 international standards, they are actually there. You can choose to elect other methods to be used. Rarely we've seen circumstances that they actually create and engineer their own methods, unless you have found a method that is justifiable and highly appropriate for your circumstances. And I think based on my experience in other cases where there was a case where a judge actually used a hybrid of both traditional and transactional methods to come up with the arm's length pricing of that particular transaction. So it's rare, but it's possible to have other methods. And on top of that, and what Shannon has mentioned with the simplified record keeping options, where if you satisfy the assessment of using the STPRK, then you can then opt to use that basis and forego using the 5 methods within the transfer pricing. Right, that the STPRK is more in line to Australia only. So please bear in mind when using STPRK, it doesn't mean that the other side, the counterparty, would be accepted to use the STPRK on their side as well.
Yeah. So then this is going to bring us into, and HC will start going through the international dealing schedule and the ATO risk reviews, which is where a lot of you will get exposed. And maybe by now you're actually thinking, those 5 questions, that's more than I wanted to know about transfer pricing. That reconstruction, I don't want to know about that. I'm the tax agent, I'm doing my IDS. I don't know, and I don't probably care. And the transfer pricing methods, you're probably also thinking, I don't really care either. I just want to know on the IDS. So HC is going to go through that. But the reason I'm going to tell you do want to care, and he's going to go through, is what you're going to see is the impact of those, because what we've actually gone through so far, this is what the ATO is looking at. When they sit there with their questionnaire and they're going to review your things, they're going to look at your 5 questions. They're going to look at your methods, all of these things. But what are they going to see? So they're going to see the international dealing schedule. So I'll hand it over to you, HC, to go through why is everything we've just talked about, whereas I'm sure some people are going, I don't want to know too much information on transfer pricing. Why is this actually important, and how does this link into what the tax agents are doing when they're filling out the IDS? If you want to start going through that for us.
Yeah, I think IDS, most frequently asked questions by the tax agent. And yeah, as Shannon has mentioned, it's really critical to understand at least a knowledge of the 5 questions, the TP method to be used, because once I've gone through what is within the IDS, you then have an idea on what to complete, for example, right? So now let's first look at what is the IDS, the International Dealing Schedule. For those that are not aware, the IDS is actually within the income tax return, right? It's just embedded after the question 30, after question 30, you have IDS section right there if you have controlled transactions, right? So what is the IDS? Now, this IDS, it's a risk assessment tool for the ATO. It's a risk engine for the ATO to identify risky taxpayers that have controlled transactions, right? International controlled transactions, right? So the ATO will be looking at this IDS to pinpoint who are the risky taxpayers that they need to identify and then review, right? So what the IDS does is that it provides a snapshot of the overall company's transfer pricing position to the ATO. The ATO, once they have completed the IDS accurately, the ATO would then be able to look at, in terms of your transfer pricing position, whether you're on a risky side or not. Then therein lies whether it will trigger additional transfer pricing risk review by the ATO. So the importance of IDS is that if you did not file it correctly, or if it was incorrectly disclosed, and the way that how ATO would have viewed it is that the tax returns, the IDS complements the tax return, right? So when you complete the tax return and when you complete the IDS, and when there are discrepancies between the two, the ATO can easily pinpoint where the discrepancies are, and if it's disclosed incorrectly, then the ATO would then trigger the ATO within that risk engine to conduct further review on the IDS and look at whether a potential audit will be in place. So it's really important to have the IDS correct, and it reflects both the TP documentation as well as the tax return. Now let's look at the next slide, which is what's within the IDS. Now, in the IDS, we have actually 5 sections. Section A talks about the international related party transaction. This deals primarily with the transfer pricing in relation to what we have gone through earlier. Then we have other sections. Section B, which deals with financial transactions. C would be interest in foreign entities. D, thin cap rules in place that you have used. So tax agent will most likely be more familiar with the thin cap rules. And then lastly, the section is financial services entities, where if you have offshore banking or if you have financial services entities, then these additional sections will need to be disclosed. So these are the 5 sections we will be looking at to make sure that it is in line with the tax return as a whole. Now let's look at the next slide on who actually needs to complete. Now there are a lot of tips and tricks on this, but I'll go through firstly on the theory part, where for IDS, all companies, trusts, and partnerships are required to complete if your international related party transactions are greater than 2 million in aggregate. Now, I'll mention this as well, that the 2 million includes the intercompany loans balances as well, which I'll go through later. Secondly, if you have an interest in foreign branch or subsidiary or trust, you will still need to prepare the IDS because there are other sections that do not deal with the real party transactions, but also the ITO will need to know what other branches or subsidiaries or trusts that the companies has within Australia. And in addition to the first two, the company are required to complete the ThinCap provisions that apply to them. So bear in mind that for those that are unaware, there's a new provisions, ThinCap provisions in place effective 1st July 2023, this is soon, where the ATO has introduced an exposure draft on actually changing the ThinCap rules from an asset-based ThinCap provisions to an earnings-based. That the objective is actually to be in line with the OECD guidelines, where they're actually going through the earnings-based instead of asset-based nowadays. And effective 1st July 2023, the questions may change, so keep that in mind. And lastly, if you have offshore banking unit, so when you have offshore banking unit, these are the additional sections that ATO would like you to declare as well. All right, so once we have gone through, what is the IDS, who needs to complete, and we really need to emphasize on the tax agents' point of view and their competency. Now, it is under the assumption that the IDS is completed by taxation as part of the income tax return, right? Because, once you have gone through the income tax return, question 26, 27 will deal with the IDS. Once you have actually ticked yes on those, then you actually have to prepare the IDS, which is part of the income tax return. Now, we have had a lot of queries by tax agent where, the IDS were actually prepared incorrectly previously, right? When, they based it on their own knowledge in terms of the international related party transactions that have happened at that point in time, at that particular income year. And there are circumstances where the ATO actually reviewed the IDS and came up with a lot more questions to raise queries to whether what's the percentage or what's the coding that's been used to complete the IDS. Now, then yes, Shannon?
Yeah, so yeah, I mean, obviously we've come up with a lot, and it's, it is important, I guess. Yeah, you've raised some of the questions on them coming up, and as tax agents, and I guess when we work with tax agents on it, if, and we have a number of practices around that might get us to help them do the first year of the IDS, and then, look, if the transactions are the same and it's just updating the numbers each year, great. Often, I guess when we get work to do it, if we get the work from an accounting firm and you've referred the client to us to assist on the transfer pricing documentation, if we see errors in the IDS, we actually will say to you, hey, just so you know, that IDS was incorrectly filled out. So next time you might want to do this, this, and this and get it right. We won't throw you under the bus to the client at all, because we want you to, you've sought that advice and all of that, but you don't want to be like, we do have others where we have the company coming direct to us and the IDS has been incorrectly completed, and that triggers the ATO review and that flow-on effect. We have no relationship with the accountant, so we just advise it from a professional perspective that, look, your IDS is wrong. It should have been done like this and that. So if you do come to us as an accountant wanting help on your client, just know that at all times we will make sure you look good for getting an expert involved. And if there are things that are on the IDS that maybe, shouldn't have been that way, we we won't be raising those issues with the client. We will just let you know so that you can fix it for next year. But, yeah, you're right, HC. We have a number of accounting firms that, in second tiers that get us to do the first year of the IDS, give it to them. They lodge it, they do all of that, but at least they know they've got the methods right. And that's why we talked earlier about the methods and the questions, is because those methods and questions do go into the IDS and can have the impact. So, yeah. So what's the ATO do with the information when they get all this info, HC?
Yeah. So I guess I don't blame, tax agents not having, sometimes TP may be a bit complex in certain cases. And, as you mentioned, once where we've gone through the first few parts where to emphasize that you actually need to have the TP documentation prepared beforehand, right? That's really important, because when you look at the IDS itself, it actually involves using the information from the TP documentation and then relate it back into the IDS, which means that your IDS should reflect the TPD. So yeah, so you have to prepare the TPD beforehand in order to actually fill up your IDS. So that's the most important part. Now, with the IDS, once you have completed the IDS, as I mentioned, then ATO would have full view on your transfer pricing positions in that particular income year. What ATO does is that they'll review that they are data mining all the IDSs, and then when they review, they would have each indicators to identify risky taxpayers where if you look at various sections of the IDS, for example, if you have completed question 3 or 4, and then you have specified countries. And when I talk about specified countries, it involves countries that are at a lower tax jurisdictions, or a lot of entities actually set up entities that to enjoy the tax benefits, tax incentives there, where ATO identifies these jurisdictions as higher risks. So there's one example where if you have transactions with particular countries, or you have particular transactions that involves development of IPs, rights to IPs, royalties, for example. These are some of the examples that could trigger and identify risky taxpayers, so to speak. And on the second part is, once they've gone through that, ATO will then select these risky taxpayers for further risk reviews, right? So in conjunction with looking at your IDS, they will also look at your income tax return. It goes side by side, right? When they look at a tax return, if you're loss making or something's not in line with your tax return and the IDS, then that's more or less a trigger to ATO in saying that, hey, there's a discrepancy between the two. I think that there may be the TP position may be on a riskier side, and hence the ATO would then select these taxpayers for further review. And once they have gone through a review, and if everything's okay, that's fine. But when they have gone through the review process and that they raise queries, and then if the questions that was answered wasn't up to what ATO expects, then it will lead it to a transfer pricing audit. So that is the flow that ATO uses based on the IDS, as well as other factors as well. But IDS is definitely one of the main factors that would trigger a risk review and subsequently an TP audit. Now, let's drill into the tricks and traps that we often have faced when reviewing IDS or helping tax agents to actually complete the IDS. Now, the first question is question 2, confirmation of related party dealings, a 2 million threshold including average balance of loans. And before going to question 2, actually question 26 will deal with specified countries in the income tax return. Question 27 will go through the 2 million threshold. Now, this 2 million threshold includes the average balance of loans. And the calculation of the average balance is to look at every quarter within the income year 5 quarters, the opening and closing, and the 3 quarters in between, and divided that by 5, then you get your average loan balance. So it's not opening and closing divided by 2, which we have seen often where they calculate the average loan balances. So keep that in mind. And yeah, most importantly is average balance of loans. A lot of taxpayers think that is more so on the interest side of things and not the balance of the loans. And to emphasize, it includes both interest-bearing and interest-free balance loans, right? Not just interest-bearing loans. So once, more or less, if generally speaking, if you have balances of loans, it will sort of push you up that 2 billion threshold, which means that you need to prepare the ITS. Okay, up to the next part would be question 6. Yeah, royalty or license fees. Now, again, as I mentioned earlier, you would most likely have a TP documentation in place that has covered the royalty and license fee, and then you'll be able to then relook at whether it's royalty or license. Again, this is another two-day thing on judging between a royalty versus a license. So once the TP documentation has identified and determined whether it's royalty and license, then you can then disclose the figures as either is the expenses or revenue. On top of that, you need to then make sure that this is actually based on your tax deduction / assessable income rather than just the accounting values. Again, the rule of thumb is to reflect what you have disclosed in tax return and then make sure that IDS follows the same as well. So make sure that when you fill in your question 6, look at whether it's royalty and license, make sure it's correct, then make sure it reflects your tax return. Okay, the next part is, I think, one of the most important one, which is services. It's question 8, and it has 10 different sections, 10 different types, and it's crucial to ensure that we disclose it accordingly based on what has been mentioned in the TP documentation. For example, if you have management and admin, making sure that only services based on management and admin are included here only. And a lot of cases where I've seen maybe strategic management services are actually incorporated here, but actually the M&A here involves at mostly admin type services, right? So here it should include the admin services, which is based on the employee based, but then if you have actual employee based plan, that will be in question 15, right? So that's the distinction between the services part and question 15. And we have other services to be, so next would be insurance services. Again, when we look at services, the main thing to keep in mind is provision of services. Again, services is also another category that we can talk about in another section. And you need to make sure that it's a service that's being provided and not just in insurance services case, where you're only paying for the premium and actually not managing the insurance contracts or not providing insurance services, so to speak. So a lot of cases where tax agents will look at, hey, insurance services, then they plug it into insurance services, but that's generally not the case, because there will be another section that deals with premiums in relation to insurance services, insurance and reinsurance services. Next up, R&D, another one where we are really looking at the research and development. So the key thing is actually development of, for example, software, where in your mind it may be IT, but it only relates to a development of software, nothing in the form of support or maintenance or web hosting or anything in relation to IT apart from development. So make sure that when you put in the R&D and it is in substance, as we talk about commercial rationality and substance basis, that is actually performing research and development services. And again, R&D is one of the areas where ATO will be looking into and making sure that the taxpayers are properly remunerated based on their R&D function, and to look at what's the nature of this R&D. So if you insert R&D there, make sure that it's actually research and development. And I'm sure there are also tax incentives grants available for the R&D section. Hence, there are a lot of tax agents that are actually inserting in the R&D. So yeah, to recap, software IT would be a section for support and maintenance of software or IT-based services. All right, so those are the service based questions. And next, we are going through the question 11, other financial dealings, which is again equally important, where you have inbound, outbound loans, both interest-bearing and interest-free loans. And again, average balances to be disclosed, which is the calculation I mentioned earlier. Here we talk about, we are looking into the debt based on Division 974, where it's actual loan. When we look at debt versus equity, it's an actual debt based on that definition, and it does not include trade-related finances, right? This more towards intercompany loans financing. And we'll go through, you have interest section guarantees, where you also include insurance, reinsurance, and other financial dealings, which involves foreign exchanges. On the next slide, yes, so loans, yeah, 974, I've mentioned that. Average balances, I mentioned that. And on the forex part, so any gains or losses incurred in relation to that particular loan arrangements or in totality would then be disclosed at 11G. Now, these gains, forex gains and losses, are realized gains and losses, which will reflect what you have disclosed in your tax return. So normally what I'll do is I'll be looking at tax returns. If there are foreign exchange gains or losses, then I'll then re-clarify with the tax agent to see whether any of the forex gains and losses, realized forex gains and losses, are related into the loans. And the different thing about this disclosure is that it includes other loans, other receivables and payables. It's not just your intercompany loan under 974. It includes trade-related. It includes any other liability, payable or receivable. So bear that in mind, that there's a difference here between the loan part and the foreign exchange part.
And these are all like as we're raising as the tricks and traps. We are experts in international dealing schedule, and the instructions are really bad. We struggle to understand their instructions, and we do this all the time. So those kind of little curly things in it, why make it different? It doesn't make logical sense, but that's what the instructions say. So yeah, it's all these little things that pop up.
Yeah, exactly. So, and another query that has been raised, in particularly to actually churning out, or rather identifying the forex gains and losses in relation to your international related party transactions, it can be difficult. And the rule of thumb is if you can't directly identify each and every forex gains and losses, you will then need to have a best estimate as to where it is in relation to, right? So best estimates on those. And it's actually it's ATO actually do understand the limitation on the accounting systems for some of the taxpayers. So we do still need to have that best estimation into the IDS as well. And then lastly, as I mentioned earlier, the payment of insurance premiums, where if you're not in relation to the management of contracts of insurance services or reinsurance, then it should be under question 11E. Okay, next question, question 12, which is the catch-all questions, where if you have completed, you have identified from question 5 to 11, and you have any other revenue So dealings in revenue, then it should be under question 12. For example, if any reimbursements of costs, then recharges, then it should be under question 12. Any transactions that are not part of 5 and 11, it should fall under here. So make sure that, at the end of the day, you have all the revenue dealings in one, and that all are actually captured in every sections of the questions, the relevant questions. And next slide would be question 13, where we deal with the capital transactions. Yeah, so this is more or less the disposal of tangible and intangible properties. The differences is that you need to make sure that you disclose the right methods to be used. Now, in terms of capital transactions, there may be other methods used on the disposal of capital transaction, capital in nature. For example, are you going through like a net book value or any method that's used to actually dispose that of the pricing policy? So making sure that you actually declare the right coding in question 3, and also there's a split between the tangible and intangible properties for actually more so for the ATO to identify the IP related transactions, especially the transfers of intangibles. That's something that ATO really scrutinize when they look at IP transfers. And yeah, lastly, question 14, the non-monetary payments, rather rare. Now, for these questions, it's in relation to, as you have seen, non-monetary circumstances where that arises is there is maybe an exchange of services or products as a condition for that transaction, which does not involve non-monetary payments, then these should be in here. The objective of these questions is to ensure that when a non-monetary payment transaction arises, the respected taxpayers, in particular the Australian taxpayer, would be properly remunerated in that particular transaction, so that there will not be a flag to be raised in ATO's risk engine to make sure that all these are in line with the arm's length nature. So that's like the question 14. All right, so you want me to go through the key takeaways, or you want to close off with the key takeaways, Shannon?
You go, HC, all good.
Okay, yeah. So I guess what from our current sections that we've gone through so far, the key takeaways, if you don't worry about the first 5 questions or the TP methods, when you look at the IDS, for example, you should start by completing question 5 to 11, which is the overall transactions that you need to comply. This is the total international related party transactions that you have. And question 3 and question 4 is actually a summary questions where it's separated into a specified and non-specified countries. Now you can get these specified and non-specified countries in the appendices within the ATO website, right? So as I mentioned earlier, specified is where countries in a lower tax jurisdiction. So make sure that you classify those correctly. And there are some jurisdictions that you may think is actually not in the lower tax, but they are still indeed in the lower tax jurisdiction. And another key point is that Hong Kong is separated by China. So make sure that if you have Hong Kong transaction, it's actually separated and it's not within China jurisdiction. So bear that in mind. And on the next key takeaway is ensure that TP documentation reflects the IDS. Yeah, Shannon, could you go to the next slide, please?
Oh, sorry about that.
Yeah, no problem. So basically, the rule of thumb is that the way to do it is your tax return, TP documentation, both will need to be consistent with the IDS. What you have declared in the IDS should reflect what you have declared in TP documentation and the tax return. so that there are no discrepancies. What the ATO does is, the first thing they'll do is they'll do a cross-check, right? Once they've done a cross-check, when there's discrepancy, they'll start raising questions. If everything stays the same, everything reflects exactly, then they'll have less queries to ask, or rather they won't go further into the investigation. And yeah, the next key takeaway would be TP methods. Now, we have briefly gone through the 5 TP methods. And again, you may not have the expertise in TP methods, so to speak, but then one thing you can do is to then look at the TP documentation and what methods was used. And then when you prepare the IDS, make sure that the coding that you have used in the IDS reflects the TPD, right? One key area is the transactional net margin method, which is code 11, against that of transactional net margin method on the whole of entity basis. That's the difference. So the first one actually deals with transaction by transaction, while the other actually look at the entity taxpayers as a whole, right? So that's the difference between those two codings. And then on cost plus versus fixed markup on cost, where cost plus, where you have actually performed the benchmarking within the transfer pricing documentation, while the next coding, fixed markup on cost, where no benchmarking was performed and a fixed markup was actually used in their pricing policy, right? These are the key differences that you need to.
And we see that causes confusion in some of the IDS and might get the question of the tax office. So, yeah.
Yeah, it's a bit tricky if you're not aware of the overall picture within the transfer pricing documentation. Yeah, therein lies the confusion on the tax agent side. And then, okay, the last key takeaway would be implication of disclosing accounting values. Now, the most important thing is to make sure that what you have disclosed reflects the tax return, right? So that there will not be any queries by the ATO, right? So we need to make sure that that is in line.
Yeah. So, yeah, we'll open it up if anyone's got any questions at this point. We know we've covered a lot of what would be, very, in a sense, at a technical level on it. I know some of it's more than maybe a lot of people wanted to know. But it is something that I guess, don't be, in a sense, overwhelmed with filling in the international dealing schedule and the transfer pricing implications. We do work with firms where, you can shoot out that email to your client to get validation. I call it the CYA for a tax agent, and so you've got that in your files to make sure you've got that. Once you've got the international dealing schedule, nailed, maybe we've helped you on that, you can just keep updating it, provided they don't change the operations. And then that's kind of liaising with your client saying, are things still consistent and that, but really trying to help make sure that you've actually got that communication and dialogue with your client so that when you are doing the tax returns, you are considering this. I mean, even go back to your question earlier, or your comment earlier, HC, about the question in the tax return. We've seen a number of times foreign subsidiaries, we've been asked to do documentation. We asked for a copy of the tax return. There's no international dealing schedule because the person ticked no to having cross-border transactions when everything's cross-border. So little things like that. I know the system defaults to no, but just thinking on those. So we actually, I think this would be one of the first webinars. We actually haven't had any questions. So I don't know if that means we just explain it so well no one's got questions on transfer pricing, or everyone's just like, oh my gosh, what are you talking about with this transfer pricing? Now we do have, if you've gone through Netflix, especially those in Melbourne who are locked down a lot, and you've seen everything on Netflix over the last few years, we do have our YouTube channel with a lot of different topics and on different transfer pricing areas. Transfer pricing, you want to learn a bit more about methods, we've got a 1-hour session on methods. So have a look at some of those videos, and hopefully that'll help you as well. Otherwise, we've got webinars coming up soon, a lot more detail on the international dealing schedule, a whole session on the international dealing schedule. So that's next week. And then actually the third one, that is not the tax agent guide. There is actually another one on that, to country by country reporting. So that is not the tax agent one. That's today. Country by country reporting. So if you have any of those clients that potentially have country by country reporting, or you just want to know what it is so that you know if you've got clients that have that issue, so you don't get that $500,000 fine that can come out if you don't do it. We have seen that letter come to clients, and people have phoned us, or tax agents have phoned us and said, what is this? So yeah, by all means, sign up to those. Otherwise, if you've got any questions, reach out. Happy to help. Happy to make you love transfer pricing as much as we do, or at least get it right for your clients so you don't have to love it as much as we do. But thanks very much for joining us. Sorry, we went a bit over today. We do normally try and stay in that, but you know, technology is great when it works, and then sometimes it doesn't like to cooperate, and that was apparently today. So thanks very much, everyone, for joining us, and hopefully we'll see most of you next week with our session. Thank you.
Thank you.
See you. Bye.